Morning, Shane.
G'day, Chris. How are you today, mate?
Very well, thank you.
Busy week.
Yeah, interesting week. You always love the headlines when things are tumbling. It's very splashed on the front in terms of numbers of money that's been lost, and then you have a night like last night where things have improved and not much news at all. So yeah,
Agreed.
Interesting.
Well, let's pick it apart today, shall we?
Correct. So, key points. I guess Shane and I were talking about this earlier, where I think today we just kind of touch on what's happened this week, not necessarily over the last month, because most of you will want to know, what's happened, why, and what are we doing about it. So, obviously, global equities have had some pretty significant declines over the past week, and we haven't been spared geographically in terms of areas that have suffered. Bond yields in developed markets have ended lower, but that's always a difficult one, I think, for clients to understand sometimes. If yields are down, prices are up, essentially, so your portfolio values are going up. And addressing, I guess, where are we looking at for volatility in both sets of those markets over the coming months?
I think that's always the question, isn't it? When you sort of see the volatility appear in equities, bonds, acted in a different way, and then you always scratch your head and think, well, what happens next?
Yeah, correct.
In fact, we don't really know what happens next, Chris, do we?
Yeah, I'd like to. Yeah, I'm not sure we'd be sitting here if we did, but yeah, it'd be nice.
Yeah, but I think this is an interesting slide you've just put up on the screen here, Chris, and I think it's probably good to reflect on this because we've talked about this slide consistently over the last 12 to 18 months, and for context, we've seen equity markets slide 5-ish% typically in US and Australia. So it is a big dip in 2 days, right? So it's
correct.
Especially Monday in Australia was 3.7 or thereabouts, so biggest day down in 4 years. But I think this slide puts a fair chunk of that into context, and perhaps just to revisit, when we've been thinking about this inflationary environment, the pathway forward has been unclear from the back end of the pandemic through until now, and we've kind of been sitting in this view of, where do we land? Do we see the world, this really smooth rebalancing, if you will, where, we sort of play on and we sort of get through this with interest rates rising, they will come down, volatility stays reasonably low, or do we go the other end of the spectrum and have a major recession? And, as we've shared with everyone, our view has been that we sit in the middle of that and we kind of, work our way through this. Mm-hmm. And I suppose, Chris, the recessionary word is what sparked this week's volatility, if you will.
Well, absolutely. And I think one of the things, and again, we were talking about this earlier, is it's been for a little while, markets have just been pricing in a perfect outcome, like that smooth rebalancing where everything's going to work out perfectly, and we're not going to have any shocks along the way. And the actual piece of data that came out, wasn't that negative, really. No,
it was showed, in essence, it showed a slight, 0.2, I think it was 0.2% increase in unemployment in the US.
Yep.
And it was just the fact that unemployment rose for the first time in a little while, that this fear of, are we having a recession, came to the surface, and the market probably started to rethink its position, or we're not probably having this smooth finish this whole thing, and it's just roses all the way through, and we get back to that point where it asks questions and we get volatility again.
Correct. And I guess some of that is also put in the backdrop of the conversation that's been had in markets over the last probably 6 months, to your point earlier about, where is inflation and what's going to happen. There's been a lot of conversation about, are the central banks leaving this too long? Like, are they going to, I guess, overcorrect almost? And then you get a piece of data in the context of those conversations, and all of a sudden it's a recession because they have left it too long. Like, we thought this, we were right, sell, and then it just becomes a spiral.
Yeah, and momentum drives it. The headlines get back on it, fear, strikes again.
Yep.
And I think if we look at, kind of this slide again, where we see volatility in CPI or inflation, we've seen kind of that trend down globally. In Australia last week, we had a good read on inflation where it was 3.9, broadly in line with expectations, or probably slightly better than what the market thought. So we're trending in the right direction on that front. We're seeing interest rates stay reasonably stable, as we thought they probably would. Mm-hmm. And again, the question becomes, when do they cut? It's not really a question of if now, it's sort of more when.
Correct.
And then, of course, GDP around the globe has been slowing a touch, right?
Yeah. Yep.
But I think the interesting part now is that, exactly to your point, have they left it too long? And that's the question that we don't know. And maybe do we need to fear it? That's the other unknown as well, right?
Yeah, correct. Yeah. Well, yeah, I guess that's what's driving all this, isn't it?
Yeah.
Or have they?
Well, I think, and the thing that it's interesting to note is that, we've seen, enormous raises in interest rates globally since the pandemic. And the interesting part about interest rates is that they're sufficiently restrictive economically, but the reverse happens too when they start to cut. And, probably what we'll probably see more data of, and that's probably why we sat in the middle of this, muddle our way through. The more data that comes out, it's unclear as to whether it's good or bad, and that's hence you see this volatility.
Yep.
But at some point in time, rates will start to reverse back to give a bit of a boost back to the economic growth of the developed worlds, particularly.
Yeah, correct.
But again, the question is, have we waited too long for that to happen, right?
Yeah, well, hopefully not. I guess that's the wish for most people. But then also, like, I have some sympathy for the central banks out there. Whereas if you go too early, then you end up in a position where all of this takes off again, and you're damned if you do and damned if you don't. But it's in a context of the last week. Like, is there anything in there, do you think, that's actually showing that we're headed for, I guess, that fear recessionary outcome?
It doesn't, like, at the moment, again, you can only work with what's in front of us, but it doesn't feel like a raise in unemployment is actually, or a minor raise in unemployment is the catalyst for the recession that we might ultimately have. And I think the part about that is, of course, is that by design, that's what it's what's actually been designed to happen.
Correct.
So you raise rates, jobs will slow up,
Yep.
and we will see unemployment rise.
Correct.
That's exactly what has been designed to happen to slow inflation globally,
Yep.
right? So it's not unexpected what's happening here. I think exactly to your point earlier, the markets have probably just been a little bit, aggressive, I suppose, in regards to its expectation, and that we'll see rates rise. We've buffered it for a fair while, and then they're going to get cut, and it's party time again. The market's just going to go boom.
Correct. Yeah.
It's unrealistic. We feel. I think it's safe to say.
I completely agree.
That's the scenario that plays out.
Yeah, absolutely. It's almost feels like a bit tantrumy in a way, but that's markets, really, isn't it? It's like, well, we expected this. Reality didn't meet expectation, so let's throw a tiz, basically.
Exactly right.
So.
But let's think about interest rates, and maybe we'll share the slide about what's happened in context, right? Where the markets have actually been to. But the actual interesting thing about interest rates is, at the moment, Australia, we're today Wednesday here in Australia, so yesterday the Reserve Bank met, and they spoke about our rates, and we chuckled this morning, Chris, didn't we, about Governor Bullock said yesterday rates are on hold for at least 6 months, and you couldn't help but feel that there was an element of Governor Lowe said rates will be on hold until 2024, and the fact that they put that sort of stake in the ground was interesting, but it was in question times, and maybe we'll give her the benefit of the doubt.
Yep.
In
Definitely surprising. When I heard that, I was like, really? Really? But as you said, to be...
Yeah. And the question that we kind of feel about all the information for context is that all the forecasts around inflation falling in Australia have factored in the recent round of tax cuts.
Correct. Yep.
But they are still somewhat of an unknown quantity, right? And this is a good thing, right? It's not a bad thing. It's just simply we've got households have got more money through another mechanism that's not interest rates.
Correct.
And it needs to sort of work its way through. So Governor Bullock being a little bit, aggressive yesterday in her tone is probably sensible in so far as curtailing this fairy tale land that we're going to have rates get cut and it's a party again, everyone's happy, and let's just say again quite clearly that there are still risks in the world that are uncertain at this point in time, which is, I guess going back to that theme of our discussion today, is that volatility in the middle of all that is an expected outcome. Yeah. When you have these types of environments.
We don't live in a perfect world where, tax cuts are going to deliver X, basis point, impact like steadily over the course of the next 6 months to, inflation or to GDP, whatever happens, whatever statistic you want to be measuring it at. Yeah, it fascinates me that, there are reactions to this when all of this is, none of this is known. It's all a very inexact science. And, for there to be, I guess, a response such as what we've had, given that it's expected. It's puzzling.
Well, do you want to share that slide, Chris? I think it'd be interesting to have a look at what the markets have actually done over the last 12 months.
Yep.
In context. So you look at this, and I think what really is important about this chart here is it shows obviously a big dip in the last few days. And
absolutely.
To your point earlier, the bleeding stopped a little bit over the last 24 hours. But it was only September through to November last year where the similar discussions that we're having right now were absolutely front and centre on every headline every day.
Correct.
And you see how the markets behave there. And then we had this expectation that we get back on our merry way. Markets have rallied, and now we've got that same scenario again where we get a little bit of a crack in the data, not significant, but certainly a crack, and markets fall. So I actually feel as though this environment that we're living through is exactly what we're going to see for a period of time. It can't not, I guess, is the way I feel about it.
Yeah, no, look, I think we completely agree. It's like it's just going to be more of this essentially, and then my expectation is that the market participants will go back to saying, "Oh, right, it wasn't that bad. Okay, things are okay. Obviously, market prices will continue to move up, and we'll see what the data delivers." And I'm assuming that every time there's something that is slightly off to what the market's expecting, then expect to see maybe not the quantum potentially, because it has been, like, if you look at that graph from November last year, like, it's been a pretty good run over the course of the last 12 months. But yeah, I'll continue to expect volatility essentially.
And if you look at the middle there, that orange line in the middle on this slide, I mean, that's probably the blend of Australia and global equity markets, and that's probably more akin to what our investors have seen in their portfolios.
Correct. Yep.
So it's again, in context, we're not underplaying the significance of what this week has presented.
No, not at all.
But perhaps sort of putting some context around it, that it's not unexpected that this is an outcome when you have data that's inconsistent with what the market's pricing.
Yeah, so I guess the conversations we've had so far are definitely around, I guess, specific markets. I guess look at this from a total portfolio level, because ultimately investors and clients will have a total portfolio makeup. So that's going to have equities, but then also have some, I guess, bond exposure. So do you want to, I guess, talk through what's happened in, I guess, what we would typically call the defensive asset classes?
Yeah, it's such an unusual thing, right? Because you probably hear on the news, the US 10-year Treasury bond yield or the Australian bond yield, and instantly last week when we saw equity markets fall, bond yields also fell.
Yep.
Which is basically the forecast of what the market expects interest rates will do in the foreseeable future. So we've got different, obviously, terms on bond yields. But yeah, typically speaking, when you get a dip in equities, bond yields fall, which is essentially the market saying, well, recessionary conditions, we may get there, we may not get there.
Yep.
But either way, when economically things slow down, we get, we're going to see a cut in interest rates at some point, and hence bond yields come down. But the flip side of bond yields going down is the opposite of what we saw back in 2022 when we had a really difficult period of time for bond valuations. Is in this instance, bond valuations actually go up.
Yep.
So we get a little bit of buffering from equity volatility. We get buffered a little bit by bond valuations increasing to an extent that kind of, I don't think it fully negates the volatility in equity markets, but it certainly does take the edge off when bond valuations rise.
Yeah, absolutely. And I think as part of the email that went out yesterday to clients, that was in full show, right? Where in a standardised balanced portfolio, the effect of having that diversified effect and was around 3.1% of the total fall. So that's a significant reduction in volatility just by having that diversification play. So whilst a lot of the headlines are going to be markets have fallen by 2% or 3% on Monday in Australia, that's not necessarily reflective of what's actually happening in the underlying portfolios for clients.
Yeah. And it's so important, isn't it? Because the news always jumps on the
absolutely
most negative bandwagon it can find.
Yep.
And rightly so, it causes a bit of fear and what have you. But I think, the consistency of message that comes through these presentations is that, diversification, as we feel almost like a broken record, matters enormously. And then,
funny, isn't it?
But it does come to the fore in moments like now, because every investor, will always have that sort of thought in mind when equity markets are rallying. should I have more money in the winner, basically?
Yeah, exactly.
And it's a natural human emotion.
Yep.
But in moments of volatility, we're quickly happy or reminded and very happy that we have stuck to our,
Correct.
risk mandates and sort
correct.
of and decreased volatility as a result.
Correct. So in terms, I guess, of we've talked a lot about the volatility that's going on at the moment because of, I guess, central banks and interest rates, which, talking about broken records, I feel like I've never talked about a theme for so long over this period. But we're coming into, I guess, US elections in November, which is typically a normally you see volatility increase, particularly in the US, and then obviously the rest of the world reacts. How do you see, I guess, those two playing out together over that period?
Look, I think it's a good shout out because I really feel as though the reaction last week to an increase in unemployment is probably exacerbated by the political system that is the US election. And again, uncertainty or fear that kind of resonates in a market always becomes a bit more heightened when there's and I think for us here in Australia, we look at the US presidential election, and I can't help but scratch my head sometimes and think it's kind of such a circus the way it plays out. But whereas here, where it's a bit more civilized the way our election unfolds, whereas over there it's kind of, and of course we've had Biden step down, assassination attempt on Trump. So there's a degree of unrest in the US as it is, and then unemployment rises marginally, and then subsequently you can see why the reaction is quite strong.
Yep.
And not to forget to mention as well that tensions in the Middle East have been rising as well, right? So I think you just put all those factors together, and it doesn't surprise us that you see a spike in volatility when there's just a series of negative influences, or uncertain influences, probably a better phrase.
Yeah, absolutely. And you add into that what's going on in the UK in terms of where the Bank of England and cutting rates during the week. So there has been a lot of this sort of on edge sense over the last, it's probably been the last 12 months or so. But the feeling is none of that has dissipated, really, has it? It's more of the same likely to be in the next few months until we start to see some resolutions. But ultimately, nobody knows whether we actually will start to see those resolutions and over what time frame. So
it's interesting to pick up there on the UK cutting rates. It's probably worthy of just a quick discussion, because I think that's significant in the context of the response to COVID, right? Like, rates rising, and the UK have now, cut for the first time. And I do wonder whether that's the sort of the start of more cutting in the months ahead around the globe, and potentially even in Australia, right? It'll have to follow suit at some stage.
Not for the next 6 months, though, Shane.
That's right. Yeah, that's right. We'll wait until January or February and make sure we've. Well, funny that Governor Bullock said that yesterday. I saw this morning that all the economists have now adjusted their expectation for a rate cut to 6 months from now. So it's kind of funny how you get one little bit of
But ultimately, on that point is, I don't think they're going to be that big-headed that if the data was to come and show that they needed to cut, I think they will. It's just
agreed.
Shouldn't really make, I guess, jokes about it, but it's just funny.
It is, yeah. I mean, I think they're doing a good job, and I think you made a great shout out before, in that it'll be tremendously difficult, right? And again, in context, we haven't had a global pandemic like we had. We've never seen a response economically like we've seen, and the market being kind of very exuberant about we're going to have this amazing outcome as a result of it all is been a little bit unnecessary, really. We're just getting a dose of reality, I think, is
correct.
how it is, but it's not necessarily doomsday by any stretch.
Yeah. It's interesting how we all quickly forget as market participants, the world will play out no matter what we expect it to do. We just continue to have unrealistic expectations.
And we're just participants in the journey, right?
Yeah, correct, exactly right.
But I think that's interesting. I think they're probably the main points I want to sort of talk about around the week that has been. And I think we've got some other slides in the deck here that we will perhaps leave in the deck for people to have a look at as they normally do.
Yeah, more for consistency of information, I suppose. Yeah, so just for those who do actually go through the deck, it's in the email. If you get the email, it's in the links in the YouTube description if you're in there, and if you're listening to this on the podcast, it's also in the descriptions in the podcast too.
And maybe just to round out, Chris, it might be worth just visiting our last slide that we always touch on in regards to, and this is like us a broken record, market timing.
Market timing.
And I think it's such a great chart just to consistently reflect on in a when we see a week like we had, we instantly look very short term.
Absolutely.
And it's and I say that respectfully because it's such a natural human emotion to get a bit worried and fearful of when you see something happen that doesn't make you feel good.
Correct.
So we look very short term, and it's people like us our job basically to take us out of the short term and kind of remind us about the journey that we've had. And I think we've seen enough data today to say, well, let's be mindful of this volatility.
Yep.
It's not unexpected, the volatility that we've seen, but in context, the portfolios have been okay over the journey, and of course we hope they stay okay. But this chart here does show that remaining invested through periods of volatility typically rewards the patient.
Yeah, absolutely. And I think the one we added in last month where you're talking about the best and worst days are close together. So by those who decided to jump out on Monday potentially or Tuesday almost, because you get Monday's bad news and then you go, all right, I need to sell out on Tuesday, and then you end up with a day where markets are up 1 and 1.5%. Ultimately the really good days follow the worst days. So trying to get in and out is just destructive to value. So try and avoid that where possible.
Agreed. And just in conclusion, obviously this is a general advice by nature. So that simply means that the concepts that Chris and I talk about today are general in nature, and of course anything that's specific to your personal affairs, we of course will talk to you about that individually offline. So, but yeah, that was a great discussion, Chris. I think that was hopefully been valuable for listeners.
Yeah, absolutely. And we'll see you next month.
Sounds good. Bye for now.